Hello everyone, thanks for checking out my video. The US stock market has been acting like a beast as the S&P 500 hit a record high almost every single day last week, with Microsoft, Nvidia and Meta all hitting their respective all-time high as well. Meanwhile, we have a huge week ahead with FOMC meeting and various big tech earnings taking the center stage. As you can see last week, good earnings by Netflix saw its stock pop more than 15%, while poor earnings report from Tesla caused its share price to tank by close to 14%. So investors have to be mentally prepared for lots of volatility this week. Also in this video, I have quite a fair bit to cover for my options trades, as I basically sold a new put contract, wrote one, and took assignment for one. Lots of things to cover, so do watch on to find out more. Last week, the S&P 500 had closed at a record high for 5 straight trading days. This is quite phenomenal as it is the longest streak since November 2021. The likely reasons for this massive feat are due to the encouraging economic data that was released last week. First of all, we had the US GDP growing at an annual rate of 3.3% in the fourth quarter, which surpassed the market expectation of 2%. This simply means that the US economy continues to remain healthy and resilient, and consumer spending is still strong. And just when some may think that strong consumer spending could fuel inflation, Friday's release of PCE index gave investors positive news. Basically, the Federal Reserve's preferred gauge of inflation, aka the PCE index, came in line with expectations at 2.6%. In addition, the core PCE inflation fell to 2.9%, slightly below the forecast of 3%. And if I am not wrong, this is the lowest core PCE inflation number since April 2021. In short, the numbers from both GDP and PCE were positive last week. It gave investors hope that a soft landing is more and more likely to happen, a scenario where the economy continues to stay resilient or maybe just softens a little bit, but is still positive, while at the same time inflation continues to ease. Alright, this week it is going to be a very massive week, probably the biggest for the first quarter of 2024. First of all, we have the very first FOMC meeting of the year, happening on 30th and 31st January. Jerome Powell and his team is widely expected to hold the current interest rates for the 4th straight meeting in a row. The real focus for the stock market will actually be on what's ahead. Investors will be looking for hints from the Federal Reserve on when will the first rate cut begin. Basically, it is a matter of when, not if. Some are anticipating a cut in March. Personally, I think the recent good news on the resilient US economy and easing inflation do give the Federal Reserve some time to consider whether they want to cut interest rates soon or not. And to me, a rate cut in March is really a toss of a coin, basically a 50-50 chance, a very close call. Meanwhile, it is also worth highlighting that various Federal Reserve officials have recently signaled that the first round of cuts won't arrive until later in the year. So let's see if we can get further updates from Jerome Powell himself. Come this week, we have major earnings lining up as the world's most valuable and influential tech companies report their quarterly results. The notable trillion-dollar mega-cap giants are Apple, Microsoft, Google, Amazon, and Meta. Alphabet, aka Google, and Microsoft are kicking off the big tech earnings on Tuesday, 30th January. You can throw in AMD here as well because its earnings could potentially move the share price of Nvidia. And then on Thursday, 1st February, we have Meta, Amazon, and Apple. In case you are not aware, these few companies have a combined of more than $10 trillion market cap. Therefore, their results and forecasts of 2024's outlook will have massive influence over various industries and areas, such as chips, software, online advertising, e-commerce, cloud computing, and of course, artificial intelligence. On a side note, it will be interesting to see whether Microsoft can finally overtake Apple and solidify itself as the biggest US company after their earnings report. I mean, one company is expanding massively in the red-hot sectors of AI and cloud computing, while the other faces several headwinds in their product sales. With Jerome Powell speaking this week and with most of the stock market or indexes movements closely tied to the performance of the mega cap tech giants, all in all, it is going to be an influential week that could set the tone and direction of the US stock market for the next 1 month or even the first quarter of this year. Let's now cover the technical analysis portion. If you could recall, I shared in my last video that when a stock or an index hit an all-time high, it will continue to fly higher a little while more before a pullback comes. So we had that fly higher last week as SPY kept hitting a new record high almost on a daily basis. So here comes the question, will the pullback come this week? Well, I don't know. And in case you are new to this channel, I would like to highlight that technical analysis is not meant to give a prediction of a definite outcome. It is an if-then thing. In other words, if something happens, then a particular scenario will likely play out. Alright, let's check out the chart. SPY has broken out of this green dotted uptrend channel. That's bullish. But will the breakout continue? Here's what to watch. In fact, I shared it last week, where I said that SPY can fly to 485 or 490 for that matter. I will not be chasing this rally. I will wait and watch for the very first pullback outside of the channel. At this point, I would also like to highlight that there is a bearish divergence formed on the RSI, which gives us some probability of a retracement this week. This could be invalidated if the RSI curves back up again, so watch it very carefully. But let's say RSI continues to curl down, it means the bearish divergence is playing out and a pullback could happen. That is when you have to watch and see whether SPY can bounce off the top channel line or not. If it does, and it goes on to break the recent all-time high of 489, I think we could be on the way to 500 in the next 1 or 2 weeks. However, if SPY falls back into the channel, then watch for the first support zone at around 467 to 469, where the first Fibonacci retracement level and 50 moving average are. If we bounce off from here, again it's considered bullish. So to summarize, watch for 2 potential areas for bounce. First is the top channel line. Second, it's this 467 and 469 area. In the event that we don't bounce from either of these levels, that means the trend has turned slightly bearish. That's when we can expect a deeper pullback, and we are talking about 450s range. In the 450s range, the first support is at around 458. And if we ever fall to this level, that's a 6% drop from the current price of 487. And in my opinion, it's still healthy. Only when this area breaks, then yes, it's something to be more concerned about. Moving over to Apple. Well, before I go into the details, I am of the view that this week's earnings will determine if Apple will hit a new all-time high in the next 1 or 2 weeks, or will it fall back below 190 again. I know the market is unpredictable and tend to do the opposite of what the majority thinks, but my view is that I am not very hopeful of Apple's earnings. I mean, while Microsoft, Google and Meta are busy riding the AI wave and Nvidia is riding on the huge demand for its chips, Apple seems to be out of idea in terms of innovation. Couple it with declining demand for its iPhone in China, I am not too convinced that the earnings can push it to all-time high. I am leaning slightly towards the bearish camp, but I could be wrong and I stand corrected. So let's say if I am correct, it doesn't mean Apple will plunge like Tesla. It could be a period of consolidation. Anyway, 191 is the very first support, but because it's reporting its earnings this week, so I think if Apple wants to go down, this 191 is just too weak of a support. And not trying to scare you, but if we get disappointing earnings or forecasts, don't be surprised to see Apple falling below the 50 moving average and the second Fibonacci level and go all the way to fill the gap at 182 to 185. But just to clarify, this drop, if it ever plays out, may not happen overnight. Below this gap, watch for the 200 moving average as the key support level because Apple has a history of bouncing off this level since it embarked on this monster run that started in January 2023. If this level breaks, all I can say is good luck to the bulls. Meanwhile, don't forget about the potential market manipulation that I mentioned last week. it could be a case of Bank of America or other institutions bumping Apple from 180s to 190s so that they can sell it off at a higher price. That's when retail investors become the big players exit liquidity. Okay, but a disclaimer, this market manipulation thing is just my wild guess. Take it with a tablespoon of salt, alright? Anyway, always be prepared for the unexpected. So let's say if I am wrong and Apple's earnings surprise investors positively, it's quite simple and straightforward. Basically, we can expect Apple to slowly grind up to 200 level. And remember I said when the stock hit all-time high, it will continue to run up a bit more. That's when bulls should let it run, while bears will have to exit their short positions above 200. Okay, let's now cover Tesla's chart. Wow, just wow. Tesla was down close to 14% last week and plunged almost 30% over the last 1 month. It is probably one of the most unloved stocks in the US stock market right now, and definitely the least loved stock among the Magnificent Seven. Actually, if you have been following Tesla's earnings over the past few quarters, this massive drop shouldn't really shock you. As you can see, back in April 2023, Tesla dropped 9.75% post-earnings. In July 2023, it fell 9.74%, and in October 2023, it plummeted 9.3%, and this time the decline was 12%. As Tesla plunged, it also invalidated the potential bullish inverse head and shoulder pattern. So what's next for Tesla? Will it continue to fall to 150, 100, or even below 100? Or will it stop its rot? Let's look out for some clues. First of all, I shared in my last video that if the recent low gets breached, we will likely waterfall down to 170s range. Tesla hit 180 last week, so we are almost there. Come this week, nobody can accurately tell you whether Tesla will break 180 or not. But if it does, watch for 177 as the first support level, followed by 167. Pay special attention to 167, because if that breaks, can you see that gap down there? Tesla may flush all the way to fill that gap, between 146 to 152. Okay, in my view, right now, it is the period where you will see paper hands investors who have lost confidence in the company getting flushed out. The biggest question mark is how many of these people do we have? It's almost impossible for one to predict when will this flush out end. Will it end at this level, or will it go all the way to 160s or 150s range? My take is if you are unable to swallow extreme volatility, then stay away from Tesla stock during this period until the dust has settled. Meanwhile, I think Monday and Tuesday's candles will prove to be quite important. If we can create a higher low each day, then we could potentially have a short-term bounce. Note the word short-term, because market makers can bring up the stock a little bit to cool off the indicators and then flush it down again. If that happens, take note of the support levels that I shared earlier. But how do we get confirmation that 180 is the temporary bottom for this latest flush out? Watch 194 and 200. 194 was the recent low and 200 is a psychological level. If we can reclaim these two levels this week, then 180 could be the temporary bottom. Resistance will likely come in at the top end of the gap, which is around 207. If we see about 2 green candles above 207, mind you, if Tesla can flush 10% down, it can rise 10 to 15% very quickly as well. So 2 solid candles above 207 could see the boost pushing Tesla towards 220. Okay, this video is getting longer because I have so many things to share with you guys, so please allow me to have 30 seconds to garner support. Anyway, if you like my free content and free sharing, do consider buying me a super thanks. I will be very grateful. I am hoping to achieve my little milestone of cashing out my very first paycheck from YouTube. Alternatively, you can just simply tap on the like and subscribe buttons and comment something below. It will help this channel a lot. Let's now check out Google. In my previous video, I shared that bulls will have a chance to bring it to 149 to 150 area, and I wouldn't be surprised if it charges towards the all-time high at 151.5. After which I thought resistance will come in. Well, I got the first part correct, but the resistance did not really come in. Or maybe I should phrase it as, the resistance has not come in yet. Remember, I have been sharing that typically when the stock hit all-time high, it will likely continue for a while before a retracement comes. And Google's current movement is pretty much in line with that pattern. The pivotal day will be on 30th January where Google reports its earnings. Post-earnings, if Google does not fall back into the uptrend channel, it is very bullish. It can basically continue to charge towards new all-time high again. What I personally think it's even more bullish is that Google retraces back to test the upper channel line and then bounces up. As for the bearish thesis, watch for the 161.8 Fibonacci extension level. That's one big resistance level. If Google gets rejected, again your support would be the upper channel line. If that support does not hold, I think we could easily fall back to 147 to 148 area where the gap is. But even if this happens, it's not too much of a concern. It's only when Google falls below that uptrend channel, then yes, bears are gaining back control. Moving over to the options trading segment, quite a fair bit of things to update this week. First up, I saw a new Tesla put option, which is a slight bullish move. Well, am I crazy? Okay, hear me out. The put contract was sold on 25th January, one day after Tesla reported its disappointing earnings. The strike price is $150, expiring 8 March 2024. The simple reason why I sold the put is because of a technical rebound. Okay, to explain a bit more, so the RSI for the 14-day time frame has dropped to around 17.5, which means it's very severely and super oversold, so there is a chance for a technical rebound. For context, I zoomed out the chart and tried to find the number of times where Tesla's RSI fell to this level. Lo and behold, it only happened once, and that was in December 2022 when the indicator dropped to 16.5. Shortly after, Tesla fell to a rock bottom of 101. And other than this occasion, the indicator has not fallen to this level in the history of the stock since its IPO in 2010. Not just that, the candle has also fallen below the lower Bollinger Band, which again increases the possibility of a short-term bounce. All in all, the 12% drop in a single day looked a little extreme to me, and therefore I stepped in to sell the put with a strike price that I wouldn't mind buying Tesla shares for. To add on, 150 is also where the all-important 161.8 Fibonacci retracement level sits, which offers a strong support. But of course, the caveat is an oversold stock can always remain oversold and can continue to go lower. And just like my previous Tesla trade, I don't deny this is a risky trade. But I have still entered because I have done my due diligence and homework, and this is why I never recommend anyone to follow my trades blindly. Speaking of following trades blindly, I have decided to take assignment of 100 shares of Tesla for this particular contract. Again, this is the reason why one should not follow my trades blindly, because you wouldn't know when do I decide to take assignment or roll the contract. Anyway, this particular put option on Tesla was expiring last Friday 26 January. The strike price was $190, and it was evident that Tesla was unlikely to close above this level on Friday. But instead of rolling the option, I decided to take assignment. In short, come Monday, I will be purchasing 100 shares of Tesla at $190 per share. This will be auto-executed by my broker. Okay, the reason for taking this assignment is because I am absolutely okay to purchase more Tesla shares below $200. From here, I will proceed to sell covered call against this 100 shares this week as part of the options wheel strategy. Don't know what is that? I have done a video on this strategy. It's beginner friendly and very easy to understand, so do check it out at the link on top. Anyway, in terms of the covered call strike price, I haven't thought too much about it yet because I want to see how the stock moves on Monday or Tuesday. I could do 190 to get more premium, or I could increase the strike price to 200. I will update again in my next video, so do subscribe to my channel if you want to stay updated. Finally, I have another Tesla put option that was supposed to expire this Friday 2nd February with a strike price of $205. given the current bearish sentiment, I thought it is quite unlikely for Tesla to rally 12% this week to go above my strike price. And because the contract is quite deep in the money, the risk of early assignment is higher. And compared to the earlier 190 per share, I didn't want to hold additional shares at 205 per share. And therefore, I decided to roll the option. Okay, in case you are new to this, to roll an option means I bought back the put contract that I previously sold and then opened a new position by selling a new put option contract. And I always aim to get a credit out of this. I will do a video on this sometime next month. So here's what happened. I first sold a contract and received a premium of $240. Then last Friday, I bought back this contract at $2,220. This was followed by opening a new put contract where I received a premium of $2,425. Oh, by the way, the two trades, aka rolling action, can be done in just one click for most brokers out there. And with this, the entire trade will give me a total profit of $425 if the new contract expires worthless. As for the new contract, the strike price remains the same at 205, but the expiration date has been pushed further back to 8 March. Basically, I am trying to give the stock some time to recover. Well, it was an interesting week for my options trade, wasn't it? Sold a put, took an assignment, and rolled an option. Alright, some end thoughts. While earnings take the center stage this week, I think the debate over when the Federal Reserve will cut interest rates will go on. In my view, there is almost no immediate need for them to cut interest rates so quickly given the positive economic data we had recently. It is also too soon for Powell and team to declare victory against inflation. Right now, I would say the biggest questions for the Fed would be how do they move inflation from here to their target of 2%, and to achieve this, when is the most desirable period to lower interest rates? And here comes the challenge. The Fed has to be a little forward-looking, because if they are too late in cutting rates, something else may break. I mean, yes, the current economy is showing signs of resilience and whatnot, but they cannot wait till a recession before making the first rate cut move, right? By then it would be too late. Anyway, for this upcoming meeting, my sensing is that Powell will likely signal or call for a patient approach in easing their monetary policy. From there, it's really up to how the market wants to interpret his speech and move accordingly. There is no way we can predict the direction of the market post FOMC meetings. Next up, other than reacting to Powell's speech, investors may also want to see how the market handles the big tech earnings and a few economic data this coming week, such as jobs report, jobless claims, and consumer confidence. Pay very special attention to the mega cap tech earnings, especially their progress in the development of their very own AI tools. Though the AI boom and resilient economy have lifted the stock market, experts and analysts have been divided lately. Some are of the view that this crazy rally is a sign of a bubble and the market is overly heated, while others are saying this is only the start of the AI boom. At the end of the day, one party will be correct in their call, and this is a week that could give us some indication of whose analysis has a higher probability of playing out. Also, I thought to share something interesting that I found. According to this chart by equityclock.com, over the last 20 years, the frequency of a positive February for QQQ, which tracks the Nasdaq 100 index, is only 40%. That's the lowest among all the months. To add on, the average return is 0.2%, which is the third worst month, only behind June and September. So are we expecting a pullback in the technology sector? Well, of course, stats are just stats. Odds may not be in favor of the bulls, but who knows, this time round could well be the 40% where we get a green month. I mean, right now, at this very moment, things are looking great and rosy, right? I mean, you have a resilient and growing US economy, easing inflation, and almost imminent rate cuts from the Federal Reserve. What else can you ask for, right? This is also why the S&P 500 has been creating a record high every other day. With all that being said, just to quote Murphy's Law, anything that can go wrong will go wrong. So if any of this positive news turn against us, we can expect a sell-off in the market. As for the scale or extent of the sell-off, it will be very much dependent on how bad the things turn against us. But hey, don't get me wrong, I am not here to spread fear or anything. In fact, I have mentioned several times that I am leaning bullish this year. So I think there is no need to be afraid of a sell-off or a technical pullback. All we have to do is not to get too complacent in a raging bull market and take whatever pullbacks that come in our stride. My point here is always keep it at the back of your mind that the market doesn't move up in a straight line, and all parabolic moves, just like all good things, will come to an end. So will it come to an end this week? Nobody knows, but what we all know is that it is going to be an exciting and wild week ahead. Alright, if you like my content, please help me grow the channel by liking, subscribing and sharing my videos. Thank you.